Hello investors and future investors, welcome to the channel. For today's video, I'm going to be showing you how to buy the crash. I will show you how to use a bad opportunity in order for you to make consistent income. As per usual, I'll be giving you a step-by-step walkthrough of each of these option strategies and how you can relate it to your portfolio. Now, if you are new to options trading, or you're trying to use options in order to make some additional income to supplement your regular 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'll be showing you how to buy a crash, and I'll be showing you how to use such a huge opportunity in order for you to make consistent income, for you to grow your account portfolio. Now, for those of you guys new to the channel, we specialize on this channel in giving you guys strategies and options idea in order for you to help grow a small account portfolio. I too grew a small account portfolio from $300 all the way to $14,000 in a matter of 6 months. So it is hard to do, but I know it can be done. So for today's video, we're going to be using none other than the Tradedesk, and that ticker is going to be TTD. Now, for those of you that do not know, the Tradedesk is one of those stocks that has been beaten down most recently. So I think it's a perfect stock for us to use today in order to show how to buy the crash. Now, before we get started, I need you guys to do yourself two favors. Favor number one, always make sure to do your own due diligence before investing. What may work for my portfolio, quite frankly, may not work for yours. Favor number two, always make sure to have an exit strategy before entering any options contract. That way, if the trade do decide to go against you, well, at least you know how to get out. And for today's video, I'll be giving you strategies. I'll be giving you exit strategies as well, so you know the entirety of a trade. So to start off, what we're going to be doing, we're going to be going ahead and open up the Tradedesk chart. And to do that, you're going to hit the advanced feature right here. Now that the chart is open up, what we're going to do is that we're going to go out to 1 year, which is going to be representative right here of the 1 year mark. Now, I did make a recent video about Tradedesk and the pullback, so I'm not going to be giving detail about what happened here. What I am going to be showing you is how to go ahead and move forward. So what we're going to be doing, we're going to be checking out the current strike price, and we're going to be using two dominant indicators, which I use personally in my portfolio. Now, before we get into the indicators, I want to show you guys a thing of beauty right here. So as you can see to the top here, the Tradedesk for the 1 year mark is down around $46. I mean, that's absolutely beautiful. The current share price is $52.10. You guys may not know how beautiful that is, but as the video goes along, you will see that this is beautiful. Now, look at this chart. This chart, once again, is absolutely beautiful. The reason why it's beautiful is that it gives us a beautiful, beautiful opportunity, an opportunity to get in and get out and make a profit. The only other chart that presents this beautiful of an opportunity for this year, for the past 6 months so far, is going to be United Health. But everyone is focused on United Health. Let's focus on this one. This one is going to help you grow a small account portfolio. Now, the blue line right here is known as the MA200 or the 200-day moving average. What that tells you is the stock price that the whole company has been trading for the last 200 days or roughly 6 months. So if I were to put this line at the end of the blue line right here, you're going to see the Tradedesk was trading around $90 for the past 6 months. That's the average share price. Now, currently, as I mentioned, the price is at $52. So it's way below the $90 mark. The difference right there is going to be about a $40 difference, which is really, really nice. What I'm going to do next, I'm going to go down here. I'm going to draw a line right here. The reason why I'm going to draw a line right here is I want to get an idea of the support of this stock. So what the support tells you is that it tells you if the share price do decide to go down even further, it's going to show you the next level where the share price can stop. Remember, these are just guidelines. They are not exact science. So the actual support of this is going to be around the $50 range. So right now the stock is trading once again at 52. If it does decide to drop again, there's a very strong possibility it stops at the $50 price. So again, the $50 price is below the $90 price. So that's good once again. Now we're going to go down further and we're going to go into the RSI or the relative strength index, which is a momentum indicator. And it tells us whether the share price has been overbought or oversold. Currently, the RSI on this is around 40, let's say 38, 39 RSI. Now that's absolutely beautiful, because if you do decide to go ahead and use the stock right now, you're going to be getting a bargain. The reason why you're going to be getting a bargain is that with the RSI, as the RSI goes down closer to the 30 mark, that's a depiction of the share price being oversold. So a share price that's oversold, it gives you a good opportunity to pick it up if it's a very good company. So with an RSI of around 40, a current share price of $52 with a strong support at the $50 range, and the 200-day moving average of around $90. We're going to use that information in order for us to go ahead and use the stock to make money and to get a very good opportunity. So let's go ahead. We're going to go back to the Tradedesk now, and I'm going to highlight just a couple more things so you guys could use. So I'm going to go ahead and I'm going to scroll down, and I'm going to show you the 52-week low. The 52-week low is going to be $42.96, which is $43. So we just saw a very strong support at the $50 level. Can the stock go below the $50 level? It absolutely can. What the 52-week low is showing you, that this is the lowest price the stock has been for the past 12 months or 52 weeks. So it tells you right now, if the stock were to go down even lower and go back to its 52-week low, there's only a $7 difference. Remember, I just pointed out, from the current price to the 200-day moving average, there's a $40 difference. From the current price to the 52-week low, it's a $7 difference. So way more upside than there is downside. Now, scrolling down even further, we're just going to go ahead and get some more concrete evidence. Now, with the Robinhood chart, we're going to see the Robinhood investors like you and myself, they have been selling off their stock. I'm not sure why. Come on, guys, we're better than this. And let's go over to the hedge funds. The hedge funds are buying this, but this does not mean much, because the reason why it does not mean much is because the trade desk has been added to the S&P 500. So all the hedge funds and the big institutions that have ETFs that mimic the S&P 500 absolutely have to buy stocks in this in order for them to balance off their portfolios. Now, if you go to insiders, you're going to see the insiders start buying. Now, while we on insiders, I just like to let you guys know, always go ahead and do your own due diligence on all companies before you go ahead and trade those companies. I have been trading the Tradedesk for a very, very long time, so I know a lot about this company. And I will tell you this, in a couple of weeks or a couple of months, you're going to see the Tradedesk is going to start buying back its own stock. The reason why it's going to do that is because right now the stock price is at an absolutely bargain deal. So there's going to be no better time for you to buy back your stock or do a share buyback at such a low price. So that might happen very soon. Now let's go ahead and we're going to go down even further. And I just want to show you one last thing, which is going to be the fair value. So the current price of the stock, remember, is $52. However, all these analysts, in addition to giving this stock a 4-star rating, it's saying the fair value, the price the stock should be trading at right now is going to be the $82. Once again, the $82 is still above the current price of $52. Now, lastly, I'm going to go ahead and show you guys. Oh, before I do that, earnings just went by and they actually beat earnings. Earnings was good. One of the reasons why the stock has such a huge pullback is because of the guidance for the next couple of months. Now, I'm going to go ahead. I'm going to show you guys a brief history, because I usually trade the exact same stocks all the time, because what that does, it gives you enough time, enough information to learn the stocks and to learn the company. So I'm going to go all the way down. Let's do this really, really quickly. Let's go all the way down, and there you go. So I have been trading this stock from around 2021. But the reason why I bring this up is to show you the different share prices that I was using. As you can see, all the way back here, the share price is around $70, $83. And let's just go up a bit. You can see 83, 81, 76. Nowhere on this chart you're ever going to see a price of $50. So the trade desk is at an absolute bargain right now. So now we're going to go ahead using all this information I just pointed out and show you how to use this stock in order to make some money. All right, so what we're going to do to start off, we're going to go ahead and go to trade TTD options down to the bottom in order for us to go ahead and open up the option chain. For those of you new to the channel, or those of you new to options trading, This information, all this here in its entirety, is known as the option chain. What the option chain does is that it gives us enough information in order for us to go ahead and make a very informed decision. So I'm going to be using that information right now in order to show you how you could use this absolute opportunity, this crash, if you will, in order for you to go ahead and make consistent income. Now, the reason why I refer to this as a crash is because a crash is representative of any pullback that's going to be more than 20%, and the Tradedesk has pulled back way more than 20%. So this is an absolute crash. So what I'm going to be doing, I'm going to be going to buy, I'm going to be going to call, and then I'm going to be choosing an expiration date. Now, options is not black and white. There is no one size fits all. So make sure to do what works best for you and your portfolio. So what I'm going to do, I'm going to go ahead and start off with the date of June 18th, 2026, and that's going to give me 305 days to expiration. Let's go ahead and select that. Now I'm going to go ahead and choose my strike price below the current share price, and the price I will be going with is going to be the $50 mark. The reason I'm going with the $50 mark is that I just demonstrated to you that is a very clear support, that the $50 mark is a very, very strong support because the chart actually hit it a couple of times. Now, with the $50 strike price, because this is a buy option strategy, you're going to have to pay. The amount you're going to have to pay is going to be $12.45. Or, as you know, each option contract contains 100 shares. So you're going to multiply your $12.45 here by 100 shares, and that's going to give you $1,245. So if you were to pick up this particular option at a $50 strike price at the June 18th date, you're going to be paying $12.45. Now, the reason why I started off here is to show you to do a comparison. Whenever you're going to go ahead and do options, you need to play with it. The only way for you to learn options is to practice, practice, practice. So now what we're going to do, we're going to go ahead to the very next date, which is going to be September 18th. And that's going to give us 397 days. So this one is 305, this one is 397. So we're getting an absolute additional 3 months. So let's go ahead, we're going to select that one. We will be focusing on the exact same strike price, and that's going to be the $50 price right here. Now, this $50 price, we're going to have to pay $1,410. The difference between the last one, which is $12.45, and the $1,410, I think it's going to be around $165 difference. So you're going to be paying an extra $165 in order for you to buy yourself an additional 3 months. In my book, and this is aligned with my portfolio goals and my risk tolerance, I do not mind paying an extra $165 in order to buy myself an additional 3 months. The more time you have on your side, the better it is for you in order for this trade to go in your favor. So we're going to do one last one now, and we're going to go to the next date, which is January 15th, 2027. Now, this one gives you 516 days to expiration. So we're going to go ahead, we're going to choose that one. While still focusing on the exact same strike price of $50, now we're going to have to pay $1,575. Now, the $1,575 difference between this one and the one we did before, which is the 1410, that's going to give us an additional $165. Once again, this aligned with my portfolio goals and my risk tolerance because I do not mind paying an additional $165 in order for me to get 516 days in order for a trade to expire. And I will be showing you an exit strategy. So we're not going to be waiting until 516 days. All we are doing is to buy ourselves enough time in order for us to have a calm, relaxed mind. We don't need to monitor this trade every single day. So in actuality, I will be picking up this $50 strike price here, and that's going to cost me $1,575. Now, this option strategy is going to be known as a leaps option strategy. The reason why it's going to be known as a leaps option strategy is because a leaps option is going to be a long call that goes beyond a year or beyond 365 days. Hence, this is going to be a leaps option. So I will be picking up the leaps option and pay $1,575. Now, always make sure to do what aligns with your portfolio goal and your portfolio capital. You may not be able to have $1,575 in order for you to pick up this contract. However, you may have the first date we used, you may be able to have $1,245. It's a lot easier for you to get access to $1,245 to buy a contract as it is to get $1,575. So once again, do what's aligned with your portfolio. And just to let you know, all 3 strike dates that I use, they're all good strike dates that can be used. Now, before we go ahead and continue, I want to highlight something. The delta here is going to be 0.68. Now, we're not concerned with the delta right now because we bought ourselves way more than enough time in order for this trade to work in our favor. But I will show you how useful the delta is going to be with this option. Now, the other thing I want to show you is going to be the break even. Your break even here is going to be 65.6. So what this tells you is that in order for you to break even on this trade, they're saying that this share price needs to be at 65.60 or above. I will show you how to work around that. So we're going to be picking up the $50 strike price that expires January 15, 2027. That gives us 516 days. We're going to have a break even of 65.60, a delta of 0.68, and we're going to be paying $1,575. Hopefully you guys still with me and you guys understand all this, because now I'm going to show you how to use this leaps option in order for you to go ahead and make consistent income. Now, if you guys are liking this video right now, just go ahead in the chat and just type in TTD so I can know anytime an opportunity like this presents itself, I can go ahead and make a detailed video like this so you guys could know what to do. Now that we have this leaps in our portfolio, this gives us the opportunity to control 100 shares of the stock. Once you are able to control 100 shares of the stock, then you could go ahead and use it to do different option strategies. In this case, we're going to do a different option strategy using that leaps option as our collateral. So we're going to be going now to sell, we're going to be going to call, and now we're going to be switching up our expiration date. The expiration date I will be going with is going to be September 19th, which is going to give me 33 days to expiration. The reason I'm going to September 19th is that I personally like to do monthly expiration dates once I'm using my leaps as collateral. Feel free to use any of these dates here. Once again, always make sure it is in line with your portfolio goals and also your capital, what you can afford. So September 19th, 33 days it is. Now I'm going to go ahead and I'm going to choose my strike price. For this one, I'm going to choose my strike price above the current share price, and I will be going with let's go with the $60 price right here. Now, with the $60 price right here, I will be receiving money because this new option strategy is going to be an income generating option strategy. So I'll be getting $75 on a monthly basis. This option strategy is going to be known as a covered call option strategy. You could use this option strategy whenever you have secured a leaps in your portfolio, or if you do own 100 shares or more in your portfolio. What the covered call does is that it gives you consistent income as long as you stay within your parameters and as long as the trade goes in your favor. And that income is what you're going to use in order to keep growing your portfolio. Now, here's an idea that can be used in order for you to keep reinvesting in your portfolio. This $75 you get on a monthly basis, this is just an idea. Feel free to use this $75 here in order for you to go ahead and pick up an additional share. Every time you receive $75, buy one share of TTD or whichever stock that you trade in. That just helps boost your current portfolio value. So when your options go up, so too will your shares go up. Now, let's go to the $60 strike price. Now, I did show you that the break even is the $65 strike price. Now, if we were to do the $65 strike price right here, which is your break even, actually it has to be 65.60. So it has to be above $65. And the next strike price is going to be 67.5. Now, with the 67.5 is paying $21. Now, this is where you have to make these options make sense for you. Now, it is true that you need to go above your 65.60, but the 65 above the 65.60, you're only going to get paid $21. I personally am not going to hold a contract in my portfolio for a month and only receive $21. That just does not make sense to me. So remember, go ahead and do what works for your portfolio. I'll be going with the $60 price, which pays a lot more. And I think that's way better for me. Now, if the share price does go to the $60 price right now, you're still not going to be losing out because you could go ahead and employ a different option strategy, which is known as rolling your option. So you would not be losing your leaps option if you are assigned, but rolling is going to be for a different video. I don't want to make this video overcomplicated. Now, we're going to go ahead and discuss your ROI or your return on capital. Your return on capital is going to be your $75, and you're going to divide that by the amount you paid to pick up the leaps, which was 1,575, and that should give you roughly around 4.7%. Hopefully my math is mathing. Now, on a monthly basis, you are able to make 5% gain every single month. A 5% gain every month is absolutely, absolutely good, especially trading options from the comfort of your own home. To use as a benchmark, we're going to use the Spider ETF, which everyone uses as a benchmark. The Spider ETF usually brings in a rate of return of 10% a year. This option strategy is going to give you a 5% return on a monthly basis. Now, before we continue, let's just point out the name of this option strategy. Whenever you decide to go ahead and pick up a leaps option on any stock, then you're going to turn around and use that leaps option as collateral in order for you to go ahead and sell consistent covered calls. That is going to be known as a PMCC option strategy. The PMCC stands for poor man's covered call, and it does not mean you have to be broke in order for you to do this option strategy. What it does is that it allows you to be able to control 100 shares of a stock for a much lesser price than if you were to go ahead and buy 100 shares outright. In this case, if you were to pick up 100 shares of TTD, it's going to cost you $5,200. By utilizing the leaps option strategy, you're able to control 100 shares for only $1,575. Good. That's out there. Okay, so we're gonna cover one last thing before I wrap up this video. So here's the last thing to wrap up this video. Um, what you're looking to do with your exit strategy, you're gonna be using your break even in order to exit the strategy. Now remember, your break even is $65.60 and you paid $1,575, but you do it monthlies. If you are able to do, let's just say 12 months of $75, you will be making lots of money. What that money is going to do is going to help you lower your break even cost. So in this case, your $75 monthly, we're only going to be using 12 months. You're going to multiply that by 12 months and you should be able to make $900. That $900 that you made is going to reduce your break even because remember, you paid 1,575 in order for you to get the controlling interest of the leaps option, and then you're going to go ahead and make that $900. So now the amount of money you're still in the stock for is going to be around $675, and that's only after 12 months. Remember, we do have 516 days, so we have way more than that. Now, the other exit strategy, because you're able to lower your costs by selling these monthly incomes, you're going to be looking to get out at the 65.60, which was your break even that I showed you. Now, this is how this is going to work out. So when you acquired the leaps option at the $50 strike price, the share price was $52.10. Let's just use 52 to round it up. Now you're going to be getting out at $65. So I'm going to show you the amount of money you could make with this. So you're simply going to you're going to minus your $52 from your $65, and then that's going to give you $13. Now remember, we are dealing with option contracts here, so you're going to multiply your $13 by 100 shares, and that's going to give you $1,300. Now, it does not stop there. Your $1,300 is going to be your gross gain. What you want to do is get like a guesstimate of your net. Now, in order for you to do that, what you're going to do, you're going to go ahead and multiply that by your delta. Hopefully, remember your delta. Your delta was 0.68. So you're going to be multiplying your $1,300 multiplied by 68%, which is representative of your delta, and you're going to be getting $884. Let's round it up to $900. So you are going to be able to make $900 selling regular covered calls for 12 months only, and you have lots of days left in order for that to expire. If the share price does go up to $65, everything else remains equal, then you're going to be making an additional $900. That now is going to give you $1,800. Remember, you only paid $1,575, so right there you're going to be up on a trade. The reason why I use these two worst case scenarios is to go ahead and show you once everything else goes beyond what that is, if you go beyond the 12 years, you're going to be making way more money. If the share price goes way above $65, which it will, I just showed you for the history of the stock, the stock has been trading between $70, $72, $83. Also, you saw the fair value. The fair value is $80. I also started off the video by showing you the 200-day moving average of $90. So the stock is going to go back past the $65. That's why I use the worst case scenario. If the stock when the stock goes past $65, then you're going to make a lot of money on this option. You're going to make exponential returns. But again, always use the worst case scenario. Worst case scenario, you're going to come out with at least minimum $300 gain on this, which is going to be your total of selling your options on a regular basis and your capital appreciation. So that is what I'm doing with TTD, the trade desk. That's a risk I'm willing to take based on all the information that I have gathered. So investors and future investors, there you have it. If you were to go ahead and use any stock, it does not have to be the trade desk. Any stock, it must be a good stock, first of all, that has been beaten down and you see an opportunity. Then you could go ahead and pick up what's known as a leaps option on that in order to control 100 shares. Once you have the leaps option in your portfolio, you're going to go ahead and sell monthly covered calls in order to make consistent income. You're going to be making money in a couple of ways on this stock. You're going to be making it one way, which is going to be consistent income on a monthly basis, and also whenever the share price appreciates in value. And that is how you could go ahead and use simple option strategies on a stock, on a good stock that has absolutely crashed, in order for you to grow your current portfolio consistently over time. Now, for those of you who have made it to the end of the video, if you guys haven't already, this is the perfect opportunity for you to go ahead, like the video, subscribe to the channel. Make sure to hit that notification bell to get an alert when I post these videos. And once again, if you guys like these detailed videos about stocks that show opportunity where you could get in and use different option strategy, just go ahead in the comments below and just type in TTD. Now, go ahead and share this video with someone you think can benefit from its content. My mainstay on this channel is to try to help as many people as I possibly can go ahead and grow a small account portfolio. Now, until the next video, keep pushing your investments.